But another thing that's really appealing for REITs would be that the returns for us, for example. Hello everyone, this is Ronan Blue. Just taking my daily walk here today. And today's topic would be on, are REITs worth it? So REITs stand for Real Estate Investment Trust. And it's a way for you to actually have part ownership of property without actually having to own the physical property. So what I mean by that is you can actually, if you have a brokerage account, you can purchase REITs right from your account there. And from that perspective, you won't have to worry too much about the maintenance of the property or finding tenants or anything of the sort. So for REITs, all you need to do is sit back in front of your desk there and check your portfolio once in a while to see the upward projection of cash appreciation of a REIT that you purchase. So you'll be getting income on a monthly basis for the REITs that you purchase. But it's an interesting form of investing in property, because for property, physical property, you need a large sum of upfront cash in front of you to pay for that initial down payment. Whereas for REITs, you can start off with $1,000 and start investing from there, and you'll benefit from getting that income on a monthly basis. So that's pretty much why REITs are becoming a lot more popular nowadays, because the properties out there, the physical property, is actually getting a little too expensive for the average person to purchase. But the concept of flipping houses is actually not as popular as it used to be. I mean, a lot of people still do so, and do so successfully, especially for those people who are experts in the field. But you still need a lot of upfront cash to do that nowadays, and a lot of people aren't really willing to do that, and would rather just set up an account, a brokerage account, and purchase REITs. And also by getting REITs, you won't have to worry about getting a loan or having a good credit score or getting a job, etc. All you need to do is if you have an extra $1,000, you just put it into your brokerage account and you can purchase property that way. So you essentially become a landlord without actually having to have a physical property. But we have REITs for a number of different industries, like hotels, and we have it for healthcare as well. The healthcare one's actually doing quite well for us, not investment advice, but if you look at the situation with the baby boomers, a lot of people are retiring nowadays. So a lot of those healthcare facilities are becoming a lot more popular. So there's a lot of REITs there that do service in that category. But if you do have a larger sum of money, what you can do with REITs is you can diversify as well. So you can buy a whole bunch of those REITs, and that's exactly what we do as well. So it's definitely an easy way for you to look into purchasing property. So you don't have to go around neighborhood to neighborhood looking for the best type of property to invest in. So it's advantageous for those who are a little bit lazier, I guess, who doesn't really appeal to doing the footwork of finding that right property for rental, as an example. But one disadvantage of REITs would be that you have to worry about the market volatility as you do for stocks as well. But that's the same case for having physical property as well. But at least you're not locked into a mortgage. But having REITs is a way for you to build your equity and also your fixed income. It's a great retirement tool as well, in combination with your stock portfolio and your other investments as well, such as index funds. So it makes a good diversification for your portfolio overall if you're looking to retire shortly. REITs actually may be a good idea right now, not investment advice, but given that the US Federal Reserve is looking to cut the interest rates, usually lower interest rates are better for real estate, so it might be a good opportunity for you to jump in and to purchase REITs as well. But another thing that's really appealing for REITs would be that the returns for us, for example, Our returns are roughly around 7%. So it seems pretty high, and a lot of people question whether or not it's sustainable. But it has been for us for the last 5-year period, so it's pretty good. You also want to keep in mind that roughly about 24% of the REITs out there are invested into shopping malls and retail. So as you can see with the Amazon effect, a lot of stores and a lot of shopping malls are closing down. So from that perspective, you want to see whether or not your particular REIT that you do decide on choosing has a high percentage within those industries as well, and maybe you can avoid it. But the profits that the REITs make from the shopping malls and retail isn't actually from the products, but it's just renting the space to those tenants where they make the money. So that's where you get the percentage from. But of course, with any investment, you want to see whether or not that REIT has a strong balance sheet, good profits, and a good future ahead of them as well. So it does require some due diligence on your part to check whether or not you want to invest in that particular product. And there's also residential REITs as well, where they manage multifamily units and manufactured housing as well. So those are becoming quite popular as well, given that the economy as it is today, the average person, it's actually pretty tough to buy a home nowadays because it's too expensive. So that's why they have these facilities for families now. That's more affordable for them. But there's a bunch of REITs for that as well. And for that, you have to actually check out the area's population growth as well as job opportunities and other factors as well to see whether or not you'll have a consistent amount of fixed income coming into your pockets. But falling vacancy rates and seeing more rental signs is a good indicator as well that there will probably be success with that company that's running that REIT. So one of my favorite REITs, as I mentioned earlier, would be the healthcare side of the business. And the reason being is because of the rising healthcare costs and also the aging population of the baby boomers, as I mentioned earlier. But they have REITs for hospitals and medical centers and nursing homes and retirement homes that are becoming more and more popular as our population ages. So that's a good way to actually have a fixed income for as well. There's also office REITs as well. Basically how that works is companies would pay for long-term leases, and it really depends on the state of the economy and the rate of unemployment within the city to make that REIT worth purchasing into. There's also mortgage REITs as well, but which is roughly about 10% of the REITs out there. But it's a little bit risky. It's really dependent on the US Federal Reserve, on their increases or decreases of the interest rates out there. Even the 0.25 basis points or 0.5 basis points increases or decreases makes a significant impact on mortgage REITs. So a bit of a risk for mortgage REITs is that it actually, with the increase of interest rates, it would raise their book values and eventually bring the stock down. So you do have that worry as well. So I don't really have too much into mortgage REITs, but I do have a small percentage of it. But some of the points you want to look at for REITs would be that you always want to do your due diligence, of course, before purchasing any investment. But keep in mind that on average, REITs do have very high interest returns, and it's very reliant on the increase or decrease of the interest rates. But it's good to have that within the diversification of your portfolio. Maybe a mixture of having real estate and having REITs and having dividends or index funds or ETFs or bonds. Just a whole mixture of those types of assets will make a good strong case for you for early retirement or in retirement. So don't rule out having REITs within your portfolio as well. But the federal government has made it possible for the average person to purchase commercial-based projects there since the 1960s. So it's been around for quite a long time. So the reason being is back in the 60s, they gave investors the opportunity to look for other investment vehicles other than bonds and their low interest-bearing returns. So REITs became quite popular during that time period. But you have to keep note that there were times where the economy did decrease, or we went into recessional periods or depression, where REITs actually fell further down than most of those other asset choices back in the day, especially during the Lehman Shock back in 2008. REITs were pretty much devastated during that time period. But because a lot of banking institutions no longer want a situation like that to occur, they do have fail-safes, so they say, so that situation doesn't occur again. But at this time, it's actually a good idea to have it mixed into your portfolio. You can always do some rebalancing at the end of the year or mix it up with other asset classes. But having diversification is key to our portfolio at this time. But once you have that diversification together with REITs and all those other asset classes that I talk about, you'll be able to carry it wherever you want around the world. And that's essentially what we're going to do. We're looking to go abroad, and we can take all those assets that are within our portfolio there, as well as our renter property, and take it abroad. So that's the whole reason why I talk about these assets with you, for maybe some of you who might be interested in taking on investing and seeing whether or not you can become self-sufficient as well in reaching financial independence and hopefully being free. But a lot of people, they're afraid to invest into these types of investment vehicles that they've never heard of before. So they end up putting their money into a high interest savings account, and they're happy with the 1 to 2% returns, which is okay if you have extremely high income. It's fine to just put it into a high yielding savings account, but in the longer term, you can actually invest into these vehicles and get even higher returns with less money. But just remember all those simple rules that I talk about for those who have been following my vlogs here is before you do invest into anything, you want to have yourself emergency fund and no debt, or none of that bad debt anyways, like credit card debt. Having a mortgage would be considered good debt, but like I always say, debt is debt. But yeah, before you do invest into any of these investments that I speak of, it's always best to have those precautions before you do so. But I think I'll end my vlog here today. Tell me what you think of REITs in the comment section below and whether you would invest into it. If you like this vlog, please don't forget to give me a like, subscribe if you haven't already, and hit that notification bell for more of my coming content here. Thank you for watching my vlog. I hope you have a great day and see you soon.